That 40% off coupon code is expiring within approximately the next week. Check it out, link down below for the amazing courses on building your wealth. Hey everyone, me Kevin here. Let's talk about what Cathie Wood just admitted regarding inflation, and I have to say, this is something I haven't thought of before. This is actually something that adds to what we've been talking about, inflation. This is why I always try to read everything I can about inflation, whether I agree with them or disagree with them, because folks have very different perspectives. And I love it. Now, many of you who watch this channel already know that my belief is that come September and October, we are going to see a downward inflection in inflation because we're going to be out of base effect period, and we're going to start seeing companies say, hey, it looks like supply chain issues are starting to let up. Now, don't get me wrong. Supply chain issues are going to last, in my opinion, for 2 to 3 years. And we have some big benefits starting in September and October that reiterate my belief. Not only do we have Q3 earnings coming starting in October, but we have unemployment ending in September, which should create more labor supply, less wage pressure. And we have schools reopening, which again, more labor supply, less wage pressure. And overall, we should be in an environment where we are so distant from the madness of COVID and from the madness of very, very high year-over-year inflationary data and inflationary reopening data that's been happening over the last few months, including massive price increases in month-over-month data in used cars, a 7% jump in airline tickets a month-over-month. I mean, you've got some insane price increases. A lot of these things will subside by September and October, and they're already starting to show their the fact that they're subsiding. So this is why I personally have believed that we're going to see this September, October kind of inflection point to the downside in inflation. But what does Cathie Wood say? Because this video isn't about my opinion. That just kind of catches you up to speed a little bit. This video is about what Cathie Wood just added to this discussion, and specifically what she said, or what her company said, that we have not considered before, at least on this channel, because I haven't mentioned it yet. And I always like to add to things that I'm talking about, because I think that's how you get depth. So here's a chart of Webull and the price of Bitcoin, which is not exactly what I was planning on showing you, and that's because my iPad is unplugged. Sorry about that. But while we're here, I may as well mention that if you deposit $100 with Webull by going to metkevin.com/Webull, you will get yourself up to 2 free stocks worth all the way up to $1,850. Okay, now that I accidentally plugged that, let's go ahead and jump on over here. So this is ARK's investing letter number 275. The big thing we're going to talk about this is inflation or deflation the bigger risk to or opportunity for equity? Equity being stocks, of course. So I went ahead and highlighted the main parts here, and I'm going to show you exactly what the big wow factor was for me. So take a peek at this. During the last 9 months, in response to the V-shaped recovery, hey, it's Larry Kudlow's V-shaped recovery, global equity markets rotated away from growth stocks toward value stocks. This is true, and they give us a reason why, which I think their reason is pretty interesting as well. Touch on that. Commodity prices soared, increasing fears of inflation and higher interest rates, while earnings growth from cyclically sensitive companies offered stiff competition to that of growth companies. This is not the big part, but this is something to consider. Is like, hey, when does like a cheesecake factory offer you the growth that like an Apple or Tesla does, right? That's pretty rare. It's pretty rare that you're going to see that kind of movement in cyclical stocks. In this case, we call them recovery stocks because these are retail stocks that have recovered from the pandemic. So good point. You know, you had good competition there, and quite frankly, over the last 8 months, you would have made a lot more money investing in those recovery stocks than you would have in tech stocks. And so this is what they're acknowledging here, that stiff competition, given the short-term horizons of most investors in the public equity market. Nice slam here at sort of most investors here, calling them short-term investors, but quite frankly, they're not wrong. Most people are short-term investors. Dramatizing these dynamics, so during the 3 months ending March, the 10-year Treasury bond yield doubled to 1.74%. This was a record-breaking increase for such a short period of time, but also, while others extrapolated the trend in the future, ARK has maintained that inflation would prove temporary. Okay, that's not really the bomb there. I want to show you, though, quickly something that they say here that is very interesting about the 10-year Treasury bond. So I'm going to pull up the 10-year Treasury quickly. This is from Bloomberg, so thank you very much for allowing me to show this, Bloomberg. take a peek here. So what they're talking about with this extrapolation is actually something that's very, very good to consider. This is the trend of the 10-year treasury, which this was sort of a reaction to, oh my gosh, it looks like big inflation is coming. And this kind of corresponds with the sell-off in tech, which really began over here when people started realizing, oh my gosh, treasuries are selling off. Which when treasuries sell off, yields go up. Treasury yields are going up. Oh my gosh, inflation fears, whatever. Tech starts selling off pretty much over this period right here. You have tech selling off. But what you'll notice is we have this massive slope here of a rising trend, a big inflation fear. They're acknowledging that people extrapolated this into the future, that we were going to the moon. I mean, pundits were coming on CNBC going, oh my gosh, we're going to have 2.25% 10 years. No, we barely hit 1.74 at the peak, and then we've been down since then. In fact, if you draw the trend line down, if you draw the trend line now from the peak, you can actually see the trend is pretty well to the downside here. We've got a solid downward trend here, certainly not as fast as the uptrend that we had here to the downside, but we have a downtrend, and we're seeing that downtrend even more recently here, with treasury yields for the 10-year sitting around 1.47 right now. Okay, back to the letter here. While others extrapolated those trends into the future, ARK has maintained that inflation would prove temporary thanks to both base effects. This means you're comparing to last year, which makes inflation look like it's larger than it actually is. And keep this in mind, we're probably going to have literally the opposite happen next year. Think about this, and now I know this sounds a little kooky, but think about this for a moment. When you look at CPI data, you look at consumer price index, which is a number going up over time. It hit this hole in 2020 because of the pandemic and started going up. So when this was April of 20 and this was April of 2021 over here, when you're comparing into a whole, you're artificially getting a larger year-over-year comparison than if you were actually comparing to where you would have been had it not been for the pandemic, right? Well, guess what's going to potentially happen? Because we're seeing such an incredible squeeze on inflationary pressures, so many inflationary pressures right now, it's entirely possible that we've actually seen inflation temporarily inflect up a little higher, making this even worse, this exacerbating this. And it's entirely possible that when we get used car prices and chip prices and all this sort of good stuff start inflecting back down, and we get sort of a temporary downside inflection, we do a little bit more like this. It's entirely possible that next April, so April 22, we look back to April 2021, and we actually have a bunch of inflation measures that look negative. That's crazy. It's a total mind twist, and it's really hard to think about right now. In fact, I tweeted about this a couple days ago, that it seems like a total mind twist that maybe, and this ARK thing came out today, just so you know timing wise, but it seems crazy that possibly in the future we could see negative inflation readings on a year-over-year basis. I mean, consider this right here. This right here is my tweet. See, June 20th, today's June 22nd. Follow me at RealMeatKevin. Anyway, markets will continue to freak out in different industries through September and October. I believe, this is my opinion. When inflation starts to inflect down this fall, guess what we look forward to? 2022 comparisons to high 2021 prices, aka negative inflation. Doesn't that possibility feel weird to consider? And I had a little bit more of a tweet storm that you could kind of look at here. If you want to, at RealMeatKevin on Twitter is where you can follow me. But the point here is, whoa, base effects, you're gonna have the opposite probably next year. We'll see. Anyway, back to the ARK letter here. Okay, so thanks to temporary base effects, that's what we just described, caused by price collapses last year. Again, right here, boom, price collapses during the pandemic. Got it. Okay, here we go. You ready for this? This to me was the bombshell. Listen to this one. I thought this was great. And due to supply chain bottlenecks, we already know that. Here we go. That will cause double and triple ordering of supplies and a massive inventory overhang. Mic drop. Oh my gosh. Hadn't even considered that. This is so brilliant. So brilliant. I haven't even considered it. Thank you. Thank you, ARK Invest. This is brilliant. Like, seriously. I had not even considered that because we're having so many supply chain shortages now, companies could actually freak out over these supply chain shortages, because supply chain shortages don't just make it harder for them to deliver products to their customers, but guess what supply chain shortages also do? They make it harder for companies to innovate, because if a company wants to innovate and release a new product, so let's say they have a version 1 of a product and then they want a version 2.0 of the product. Well, if you have supply chain shortages, you might not have enough supply to produce both products. So you might literally take innovation in your 2.0 product and put it into your back pocket for the future. Don't believe me? Read Enphase's earnings transcript. Folks, it's literally happening. This fear and this disaster of basically preventing innovation from happening because of temporary supply chain shortages could absolutely lead to what ARK Invest is calling the double and triple ordering of supplies, leading to massive inventory overhangs where basically you fill up your warehouse with a bunch of extra supplies and you kill just-in-time transit or just-in-time inventory. Just-in-time inventory, by the way, is like the innovation of capitalism. JIT, just-in-time. Why does, oops, that's Twitter again, there we go. Why does just-in-time inventory matter? Because think about it, folks. If you're assembling a car, that's a pretty horrible car, but whatever. If you're assembling a car, when do you want the tires to show up? When you just put the frame on the conveyor belt and you're working on putting the seats in and bolting the roof on, unless you're Tesla. Okay, sorry, bad joke. and you're assembling the car? Or do you want the wheels to show up when it's painted and it's about to roll off the line and all you need to do is put the wheels on, the brakes are in, the axles are in, the motors are in, everything's in? When do you want the wheels to show up? Do you want it to show up when you're just at the beginning of the production process? Or do you want the wheels to show up right when it's ready to roll off the factory line? Well, generally what you want is you want the wheels to show up literally the day. Like just-in-time inventory would be the day you need the wheels, they show up. Now, obviously, logistically, companies, you don't generally perfect this, but you try to get to as much of this as possible, because what you don't want is to have a warehouse full of products, because those products are money that you don't have invested and they represent products that get old. You have inventory management issues, you have quality control issues, you have theft issues, you have a lot of problems. Inventory on the shelf is generally the kiss of death. Well, until of course COVID came around. COVID came around and killed just-in-time inventory, and COVID came around and said, you know who was really smart? Toyota. Toyota was really smart for hoarding inventory, something that most companies in capitalistic environments haven't been doing. Well, guess what? COVID just killed JIT. COVID made it so that JIT is dead, and we don't want just-in-time inventory anymore. And this massive inventory overhang, it could potentially lead to some big fat earnings for suppliers over the next few months, but will also potentially also lead to large cash outlays for companies that need to be buying chips and products and things like this, but will make companies more resilient to future supply shocks and also lead to a reduction of prices in the long run, because there is less pressure to buy product exactly when prices are high because you have no other choice. And this is in part why it's very likely that inflation is going to inflect downwards. We're not even talking about the fact that we're in a deflationary society, that technology makes products not only better to where we don't need as good of a product anymore, we could do with a less expensive product. I can now do with a $500 phone instead of a $1,000 phone 10 years ago. Back 10 years ago, you want the iPhone, you pay $1,000, not considering the contract subsidies that you initially got when you got iPhones. Now, you could do just as well with the $500 iPhone. You don't need the most expensive one. You certainly don't need the $1,500 one unless you want those 3 cameras because you're a YouTuber or something like that. Point is, deflation is part of our society. It's part of our future. A lot of these inflationary pressures are temporary. Now, about 55% of you watching this probably believe me, and about 45% of you watching this think, I don't know, Kevin, I appreciate your insight, but I still think we're going to have high inflation. That's totally fine. I respect you, because all of you can equally join my courses on the psychology of stocks, real estate, investing, property management, sales, and making YouTube videos via the link down below using that expiring 40% off coupon code. But folks, for right now, let's keep going with this letter here. So moving on with the letter here, what do we have? With the exception of oil, they do believe that commodity prices will begin to collapse, and they've already started collapsing. They talk about lumber going down 46%, copper dropping about 12.7%. They believe that oil prices will fall very soon, helping lead to inflation, or leading to that inflation going away, particularly if drivers in the ride-sharing space take advantage of the low total cost of ownership of EV ownership. Yeah, I don't know about that one. I think we're a little early for people getting into EV Ubers. But we'll see. Maybe. Certainly hybrids, I could see that. But I think the downtime might be a little bit of an issue still with charging. So I don't think we're there yet on that. But otherwise, I have to say, this is very, very, very interesting. I appreciate this from ARC. Thank you. Shout out to ARC. Really good job. Hadn't considered inventory overhangs. Certainly, I'm on a similar wavelength as them on a lot of things. Some of our stock picks are a little different, but that's okay. Hey, you know what? Everybody's got different opinions. But I've got a very similar outlook to ARC with some differences. This, phenomenal. Thank you. Thank you very much. Appreciate you watching this video. Please, if you liked this kind of content, consider subscribing. When you press the subscribe button, it sends a big signal to me and the channel that you want more of this kind of content. Thank you so much for watching. We'll see you in the next one.